Welcome back to your personal finance classroom, where we break down your money questions to make it easy for you to live your best life. Don't forget to subscribe and hit that notification bell so you can be notified when new videos come out. And if you found this video helpful, don't forget to like it. Today, we're answering a very popular question. What is investing? In this lesson, we're going to break down what exactly investing is, the different ways to invest, and why you should be investing, and how to get started. In simple terms, investing is buying something with the hope that it will increase in value. There are actually a lot of different ways to invest, which we'll get into in a moment. But a lot of time, what comes to mind when we think of investing is the stock market. When we talk about investing in terms of the financial world, we're likely thinking about buying assets like stocks, bonds, mutual funds, etc. that'll help your money grow over time. The thing is that while that asset might increase in value over time, and you profit from that, the opposite can also be said. That asset can lose value and you might lose your investment. Over time, assets typically rise and fall in value. While one moment it might seem like things are looking up, the value might drop the next moment. But it can also go back up. There's no guarantee that you will see a return on your investment, but the potential benefits sometimes outweigh the risk. Investing is a long game. It isn't a get-rich-quick scheme. Investing is all about building your wealth over time. A lot of people tend to invest for long-term financial goals like education expenses, buying a house, or saving for retirement. The most common types of investments are stocks, bonds, real estate, and ETFs or mutual funds. Buying stock in a company means you own a small piece of that company. You're technically a shareholder. If you bought stock in Amazon, you would own a small piece of Amazon. Companies can pay out dividends. Dividends are sharing a percentage of the company's profits with shareholders, though most of the time those dividends aren't guaranteed. Companies might decide to pay out dividends if their profits for the year were good. A stock's value comes down to how much investors think the entire company is worth. For example, if you invested in a relatively new company that seems like it's going places at $10 a share, and that business explodes in popularity over the next year, the value of that stock might be worth $100 a year later. Bonds work differently than stocks. Bonds are issued by governments or corporations. With this method of investing, instead of owning a piece of it, you're lending money to the company or government. When you invest in a bond, you loan money to that company or government, and then after a period of time, you'll be paid back along with regular interest payments along the way, typically twice a year. Since you don't own a piece of the company with bonds, you don't necessarily benefit from a company's growth. But the opposite is true as well. If the company isn't doing well, you won't see much of an impact as long as the company has the resources to stay current on its loans. The potential benefits of bonds are 1. A stream of income through those interest payments, and 2. They might be a little safer than the potential ups and downs of owning stocks. Then you have real estate investing. Real estate investing can potentially offer long-term returns that aren't associated with the stock market. What comes to mind for a lot of people when they think about real estate investing is the idea of buying property and renting it out to make a profit, or buying a home and flipping it so that it can be sold for a profit. Those are definitely ways to invest in real estate, but even if you don't have the funds or time to put down on a property or flip a house, you still have options when it comes to real estate investing. REITs, or real estate investment trusts, are public companies that raise funds by selling shares of stocks and issuing bonds. They then use the proceeds to purchase and lease real estate assets like apartment complexes, office buildings, malls, and warehouses. REITs must pay out nearly all of their after-tax profits to investors as dividends. REITs are a great way to invest in real estate immediately with little money, and they take the pressure off owning real estate. Alternatively, you could consider a crowdfunding real estate investment platform like Fundrise or CrowdStreet. These type of platforms give you the opportunity to invest in specific real estate development projects instead of just generic portfolios of properties. These crowdfunding platforms work by pooling money from various investors to fund development projects. Each platform will have different rules for how long you'll have to commit and may have fees and costs, so make sure you do your research on each platform before you decide. ETFs, which stand for Exchange Traded Funds, and mutual funds are another common type of investment. ETFs and mutual funds are similar with just a few key differences. Both represent professionally managed collections of individual stocks or bonds. They typically carry lower risk than individual stocks, since a single fund holds a diversified collection of investments. They both come with built-in diversification. One single fund could include tens, hundreds, or thousands of individual stocks or bonds. If one is doing poorly, another might be doing well, which can minimize your overall risk and losses. This was a brief overview of some of the most common types of investments. Comment below if you'd like us to do a deep dive video on each type of investment. And while all of these have the potential to make you money over time, a lot of people avoid investing due to the fear of the unknown. A lot can go right with investing, but a lot can go wrong too. Investing horror stories might freeze you with fear in your tracks, or perhaps you feel like you just don't have the money to invest right now, so that's stopping you from considering this as an option. The reality is, there's no guarantee that you will make money, but the benefits can have the potential to outweigh the negatives. And you can get started investing with just a few dollars, so dipping your toes in and testing the waters can be a great way to get started. You have to make the decision for yourself on whether you think investing is worthwhile for you, but here are some of the benefits of investing. Number 1, investing makes up for what savings lacks. Saving is great. It's an important component of a healthy budget, but letting all of your money just sit in a savings account means just that. All of your money is just sitting in a savings account. Even if you get a small percentage back from keeping your money in that savings account, your money isn't working for you in the same way it does through investing. It's a good idea to keep your emergency fund savings and saving for any goal that you have in the near future in an account that's easily accessible, like a money market or traditional savings account, and then put the rest of your savings to work through investing. Number 2, it can help you build wealth. Investing is how you build wealth, and anytime you invest money in the stock market, you are giving it the opportunity to benefit from compound interest. Compound interest is when your investment account earns interest of its own. And the more time your money has to compound and grow, there's a greater opportunity for that money to earn more money. For example, if you invest $1,000 in a long-term bond that earns 3% interest each year, at the end of your first year, you'll have earned $30 in interest. You'll now have $1,030. In the following year, you'll earn another 3% interest, but you earn that on that $1,030 instead of just on the $1,000. It will then grow a little bit more to $31.40 that next year, bringing your total to $1,062.80. Compound interest's superpower is time. If you let that $1,000 just sit there for 20 years, that $1,000 can become $3,262.04. And this is when you're not making any additional deposits to the account. Through compound interest, your money continues to grow. That's letting your money work for you. Imagine what would happen if you continued to add money to that account on a regular basis. When you invest in stocks, you have the potential to earn a higher interest rate. It might be anywhere from 10 to 15%. This means your money is working even harder for you. Number 3, it can help you meet your financial goals. You can consider investing to help you meet long-term financial goals. Long-term financial goals are considered goals you have that will stretch beyond 5 years. Again, because of compound interest, the longer the goal is away, the better. Investing your money can help you meet your goals faster. You can save for your children's education expenses, buying a home, or save for retirement. We have a whole lesson coming up on retirement, so make sure you're subscribed so you can be notified when that lesson drops. Number 4, the reward has the potential to outweigh the risk. Risk is the chance of your investment producing a lower than expected return, or even losing value. Investing is risky, there's no getting around that. But at the end of the day, the reward has the potential to outweigh the risks. Different investment types have different risk levels. The general rule of thumb is that you can be riskier with your investments when you're younger and decrease the amount of risk as you age. The lower the risk, the lower the potential return. And it's also true that the higher the risk, the higher the potential returns. So how do you get started investing? The first step is to start now. We talked about the power of compound interest. So by starting now, you're giving your investments more time. Even if you don't feel ready, and even if you can only afford a few dollars a month, it's worth it to start investing as early as possible. Continue learning as you go and continue to add funds as you can. The next step would be to decide how much money to invest. While you want to get started with investing, you don't want to put your personal finances into jeopardy to do so. Investing works as long as you aren't investing money that should really go towards your essential living expenses like groceries, rent, and debt payments. Check out our budgeting video where we break down how to make a budget so you can figure out how much you can afford to invest. Once you know how much money you want to invest, open a brokerage account through places like Elevist, Vanguard, Fidelity, or TD Ameritrade. A brokerage account acts as the intermediary between you and the stock market that buys and sells assets on your instructions. You can find a variety of options from full-service brokers to automated robo-advisors and online brokers. Do your research and find the one that works best for you. And finally, automate your investments. Automation is a huge part of financial success. When you automate, you don't even have to think about it or take time out of your busy schedule to take action. Set up an automatic transfer from your checking account to your investment account on a regular basis so you're continuing to add funds and your money can grow. That's it for today's lesson. Let us know in the comments if you want us to do a deep dive into how to get started investing. Don't forget to like and subscribe. We'll be back Wednesdays and Fridays with new personal finance lessons for you.